So welcome to this IIES SNS seminar on the value of big data. My name is Tessa Bold. I'm an associate professor at the University of Stockholm. I should say also, as you can possibly hear from my voice, I've caught a rather bad cold, so if I get a sudden cough attack, I might have to flee the scene for a few moments, just to warn you. But yes, so welcome everyone to this seminar. Very nice to be here in person. Have many people here live in person, and also welcome the people who are joining online. So big data has really become a buzzword recently, and maybe some of you, certainly for me, might have a sort of a little bit of fear of missing out on big data. Like it's something we're told we should be doing something with. You know, as a researcher, I'm constantly, oh, you're working with big data. Maybe as companies as well, you're being told, oh, big data, you can really benefit a lot from this. So a little bit, what is big data? It's actually not terribly well defined. So data has always been around. We've always been using it. But what really is so different about big data is just the sheer amount, the amount by which it has multiplied over the past decade or so, or even longer, and also our ability to process it. So I think what the panelists will tell us today is that companies should be excited about this because there is a lot of potential in big data for them. Also, as a researcher, I find it exciting because the more data there is, then in principle, the more I'm able to learn about the world. As an individual, I have to say I'm also a little bit weary about it. Generally there's so much data collected about me, and then there's sort of concerns that it might be misused, for example, as we had in the Cambridge Analytica scandal. So I hope that today will be an opportunity where we can look at all these dimensions and issues surrounding big data. So both its potential and its role in the economy, but also perhaps some risks associated with it. So with us today as our main speaker, we have Maryam Farboodi. Maryam is an assistant professor of finance at MIT Sloan School of Management. And I have to say she's doing super impressive and cutting-edge work on the role of big data in finance and the wider economy. So in her research, she's really helping researchers and policymakers to understand this new class of asset, big data, how it is valued, how it should be valued, and what its effects are on the wider economy, and whether there are winners and losers, I think, from this big data revolution. As panelists, we have Anna Albinsson, who is the CEO of the Whispr Group, and we have Sven Törnkvist there, yes, who is the head of EQT Digital. Anna Albinsson is CEO of Whispr Group, and that's a leading PR marketing company that's using big data to help companies to understand customer demand, market sentiment. But they've also been working, for example, in advocacy and campaigns. So one of their recent clients was helping a campaign for the reform of the justice system. And then Sven Törnkvist, who's the head of EQT Digital at EQT Group, and that's a global investment organization with offices all over the world. And EQT has a special expertise and focus on using big data and AI algorithms to guide investment decisions. Yeah, so we're almost ready to begin the seminar. A few organizational pointers. So Maryam will now present for about 20 minutes. Or 20 to 25 minutes. And afterwards, we'll have sort of a brief discussion here about your presentation, and then there'll be a panel discussion. So for the audience who are here physically, you're very welcome to ask questions during the panel discussion. So just raise your hand. Someone will come to you with a microphone, and you can ask your question. For those who are online, you can pose your questions throughout in the Q&A, and then we'll take them up during the panel discussion as well. If you want to tweet about the seminar, then please use the hashtag SNSkunskap. And the floor is yours. And I managed to get through this without coughing. It's excellent.
thanks so much for having me here. I'm super excited to talk to all of you about this. And I want to talk about, through the lens of my research, about some of the discussions that's going on in academic research on the big data revolution, but I'm a lot more interested to hear about from the rest of the panelists about where it's actually happening in the real world. So, with that, I think we are kind of all convinced that we have to care about big data because big data is a new asset. However, as Tessa mentioned, data refers to many things. In my research, I would focus on the data that underlies this big data revolution, which is the data that is heavily used in the AI and machine learning algorithms, which are growing very rapidly in the past couple of years. And that data is used for prediction. So there is some uncertainty, and data helps us reduce that uncertainty. And this is what this whole talk will be focused on. There is data that can help in reducing the ambiguity. That is not what I will talk about. Now, in finance, the collection and processing and use of data has really, really multiplied. And you would like to understand which assets and prices are most affected. As Tessa mentioned, who are the winners and the losers. And as importantly, for also policy making, we want to understand how to quantify the data and its value, because that's really critical for policy design. Non-financial firms also increasingly use the data. And this data mostly comes from customer transactions. We would need to understand what is it used for. Do we want to have more data processing or not? Maybe somebody is being hurt by this. And then finally, what is really, really new and it's really, really blurry is the data markets. So it's really important to design and regulate functional data markets. And in order for that, we need to understand and quantify both the financial data and the customer data and value it. Okay, market design requires valuation. So let me start by showing you an evidence which I'm sure all of you guys are better than me aware of, which just points to the growth of data processing technology since 1978. Okay, this plot plots the performance of processors compared to a benchmark over time. You can see that prior to 1985, it was growing, but only like about 25% per year. After that, it has been growing for a couple of decades at like 50%. So the growth of data processing is huge. And this huge growth has been recognized by non-academics and industry and public way before. This is the cover of Economist in 2017, so 5 years ago, which recognizes data as the most valuable resource of the world. And this is the insight, which is really cool because it's basically hinting to data is the new oil. So with the difference that our new huge oil companies are Tesla, Google, Microsoft, and Amazon. Okay, this is just to remind all of us that the models of manufacturing and producing tangible goods are being less and less relevant in the modern economy, and us as economists need to take that into account and adjust our models to address that. However, unfortunately, our understanding of the economics of big data is still lagging behind. Mainly because data is difficult to interpret in our models because it's unobservable. In my research, I'm going to try to address these two specific questions about why it is hard to think about data in our models and try to suggest ways to address these two questions. First is that the data refers to many, many things, and we don't have great models to disentangle different functionalities of the data. So some of the stuff that I will show you is really about what are the dimensions that we should try to specify what data is about. And then second, the fact that data and data valuation are very difficult to quantify. And I'm gonna suggest 2 ways to do this quantification. And this is really behind in research, because we really lack data that we need to quantify the value of data and quantify the data. So, and that's where I'm hoping that, like, at some point there is a closer connection between industry and research, so that we can try to use their data to actually measure data and value of data. So, because, as I said, I want to focus on data whose role is prediction, okay? And for that, I'm going to use a model very broadly throughout this different things that I'm going to talk about, which is basically populated by agents who want to make a decision under uncertainty. And uncertainty is bad because it creates risk. The risk can be risk of profit loss, because a non-financial firm is producing an undesirable product, or because a financial firm is taking wrong financial positions. It can also be risk of injury or death. For instance, if the drugs that are introduced are not tested appropriately, or if the self-driving car is not tested appropriately. So this risk is really broad. What data does is that it can reduce the uncertainty and enables the agent to make better decisions. By making these better decisions, agents can increase profit and they can improve welfare. However, I want to argue that this is not across the board for everybody. There are winners and there are losers, even as technology grows. But with all of these in mind, you would like to understand what should we expect when this data ability and the technology to data processing improves. I want to think about, I'm going to show you some broad insights from the overview of my research on financial markets, on the real firms, as well as the data market. And I'm going to be quicker on some of the results, and I'm going to kind of delve a little deeper on things that I think are probably more interesting for this audience. So let's start by specifying what I say when I say data, okay? First, the role, the use of data, it's prediction. Everywhere that you will see in these slides, data is used for prediction. In different parts of my research, I think about different agents using data. I focus on either investors or firms. For instance, a completely abstract away from customer side of this data, which is very important for for privacy regulation and these debates. But that is not something that this research touches on. And of course, it's very important, and somebody else has to do it. Then the question is, data is used for prediction. What are we trying to predict? And I will think about the use of data given who uses it. If investors are using the data, they try to use the data to predict the firm fundamentals or do statistical analysis and predict market sentiments or market demand. Alternatively, if firms are using data, they're trying to use it to predict some optimal production quality or predict the customer taste, to basically produce things that cater to customers better. And then finally, the question is, where does this data is coming from? Depending on the context, it can come from different resources. It can come from information acquisition by investors. It can come from firm performance history, and it can come from customer transactions, okay, which is really at the heart of a lot of the discussions today. So I want to tell you just one tool that I will use all the time, and it's really the bread and butter in economics of prediction. Think about an agent who's trying to predict a random variable, Z, and what is data? Data is the signals that this agent gets about this random variable. Okay. What does more data do is that more data improves the precision of agents' posterior beliefs about the random variable that the agent is interested in. And what's really, really a critical tool to do this research is that Bayes' law says that the posterior precision is additive. That helps us think about questions in a very, in a way that is very, very tangible. So imagine there are signals about the random variable z, which all have some volatility. Okay, so signals are random and they have a volatile noise. Inverse volatility is precision of the signal. So a signal which is less volatile means it's more precise, so it has higher precision. And the key to Bayes' law is an agent who has all of these signals, his precision is sum of all of these signals. Okay. And then, okay, there is some notation, but if there was a and I don't want to go over it, but if there was some question, I'm not using a lot of notation on this slide, so I'm going to stick with this. So what I'm going to do instead is that I'm going to provide you some conceptual insights from different papers that I have in this topic, and then I'm going to talk about measurement, and then I'm going to end with some concluding remarks. The first question is, okay, how does the financial sector as a whole, how is the financial sector as a whole affected by this growth in data processing? And it's important because growth theory in general describes that a technology boosts efficiency. But in the financial sector, information technology has been blamed for volatility, illiquidity, and inefficiency. And the main concern is that the big data is not only changing the amount of data that we are processing, but it's changing what we are processing the data about. Okay, and to look at this question, we exactly build a model which allows the investors to choose to learn about firm fundamental, do fundamental analysis, versus do statistical analysis, try to predict market demand, and take the other side of the uninformed traders. And what we find is that in terms of the type of analysis that is done, there are phases of data analysis. As time grows, as time passes on the x-axis is time, technology grows. On the first plot, you can see the phases of information processing. In the beginning, when technology is poor, most investors learn about fundamentals. In the intermediate run, there's a huge boost in statistical analysis because that's more profitable. And in the very long run, they're going to grow together. Now, what about the general predictions about some statistics of the financial market? The two measures that we're going to think about is one, informativeness of prices, and two, illiquidity. What's very interesting is that informativeness of the prices, which is the red curve in the bottom plot, monotonically increases. It does not matter that some investors change what they learn about. Still, they produce, by statistical analysis, they produce information which is embedded in prices and make the prices more informative. However, liquidity of the market is extremely non-monotone. And that's with the blue curve. The blue curve is how illiquid markets are, which means how big the price impact is. And this research shows that in the first couple of decades, in fact, the market becomes more illiquid as statistical analysis grows before reverting back and becoming more liquid. But now, what about the winners and losers? Sorry, Tessa, I'm loving this term. So there is huge heterogeneity in cross-section of stocks. Okay, and if you look at the data, you can see that the informativeness of S&P 500 index has grown as an aggregate, as you would see as the previous research would predict. However, if you look at the average price informativeness of all the listed firms, it has stagnated or even fallen. Okay, so and that begs the question of whether all the firms have benefited the same way from this technological growth. And what we find is that no, there is a huge divergence in the data and information efficiency of prices. In particular, most data that is processed by investors is about large growth firms. Why? Because investors process data that is most valuable to them. And size and growth prospects interact together to make data more valuable. So it's really the large firms whose stock prices have become a lot more informative and the rest have stagnated. And I'm going to talk about this, about measuring value of data using this context. If you also think about the spillover from financial market to firm distribution, you would see the same winners and losers. In particular, in the past couple of decades, small firms are being displaced by larger ones. And we find that big data actually intensifies this trend because large firms disproportionately benefit from big data in their growth. And the reason is, as I said, where does the data come from? Data is a byproduct of economic transactions. Big firms have a lot of transactions, so have a lot of data. Investors, when they have a lot of processing power, they can process a lot of data about big firms. That means that the cost of capital for big firms who have a lot of data disproportionately falls. In other ways, the key mechanism is that data resolve risk, and lower risk implies lower risk premium. So the cost of capital is going to drop a lot for big firms. They can grow a lot, and to the extent that resources are limited, they're going to displace smaller firms that face a lot higher cost of capital. But then that takes us to this notion of how is data produced by these transactions? And in my research, I think about data that is a byproduct of economic transactions that firms use to predict some optimal production technique that helps them improve the quality of the goods that they produce. The optimal production technique can be customer taste. Like, for instance, this year, whether customers mostly use blue shirts or red shirts. It can be as simple as that. Okay? Or for Uber and Lyft, it can be, okay, where is the highest level of demand for cars? So if we can predict it well, we can send more cars there. Okay? What's very important is that data is inherently non-exclusive. Okay? That means a firm can sell the data and still use some of it. Okay? And that is a key difference from other factors of productions in our models. Capital and labor are rival, while data is non-rival. Furthermore, data is tradable among firms. Okay? And that makes it very different from this learning by doing. So if I learn something on the job, I cannot sell it. It's mine. It sticks to me. While data can be tradable. So a firm who has a lot of transactions, who handles a lot of transactions, can use the data that is produced to either produce high quality goods and or to sell it to other firms. And this kind of leads to a particular growth path for this economy. In particular, whether in the long run, data in its predictive role can sustain long-run growth or not depends on what data is used for. If it's used for innovation, like drug discovery, yes. But a lot of big data in this big data revolution is used for process optimization. And process optimization is broad. It's reduction of search costs, improvements in transportation, labor hiring and firing, management efficiency, personalization, advertisement. A lot of things that you think about are process optimization. And if data is used for process optimization, then it has decreasing return to scale in the very long run. However, in the short run, where we probably are, there is increasing return to scale. And that leads to S-shaped growth for firms. So, and that leads to, and you can see that when a new entrant enters, that leads to one data barter. What is data barter? Data barter means you provide goods and services to customers for free, in return for getting their data. And that is what we all see every day. That's all of the apps on our phones. They are for free to collect the data and improve the quality of the app. On the other hand, customers can be stuck in a data poverty trap, okay? Because they need data to produce high quality goods, okay? If they cannot get this data, they can be stuck in not producing high quality goods and get out of the market. So again, this big data revolution is not necessarily positive. We need to have efficient data markets to make this work better, which takes me to the data markets. Given that the data is non-exclusive, so it can be shared across firms. For instance, as Anna mentioned to me, it might be that you have a lot of data as a firm, but you don't know how to use it, okay? Or you can use it just a little bit. However, you can sell it to somebody else, and they can use it a lot more efficiently. And you can still use it to some degree, okay? That implies if there is a functional data market, firms must want to participate in it by themselves, okay? But these functional data markets don't exactly exist. And policy also encourages this data sharing. For instance, all the open banking regulation, which is heavily discussed, is about data sharing by large financial institutions to help entry. Because new entrants rely on the data markets to facilitate their growth. So it's very, very important. And data intermediaries emerge in this model. So a firm who is good at data processing, in fact, they're going to be larger because they need to govern a lot of transactions to produce a lot of data. But they choose to specialize in actually selling this data to other firms instead of using it themselves and making very high quality products. Amazon chooses to sell the data about shoes to Adidas. And then Adidas produces high quality shoes. Amazon does not specialize in producing high quality shoes. Instead, it invests in data production. And that takes me to the importance of measurement. As I said, I would like to think about how to measure the amount of data which is in stock prices. In order to do that, we divide stocks into 4 groups based on whether the stock is large or small, and the stock is growth or value. Okay. Then you can solve this complicated model, and you're going to see that the price informativeness of each stock price has 3 components. A component which has to do with volatility of prices and earnings, a component which has to do with the growth prospects of the firm, and a component which has to do with the data that that investors have learned and is built into this price. Okay, you can compute price informativeness, volatility, and growth directly from the data, and use that to measure the data which is about each of these group of firms, and that gives exactly rise to this notion of winners and losers. So you can see that in the past 5 decades, I've plotted the price informativeness for these 4 groups of stock: large growth, small high growth, small low growth, and large low growth, as well as their data. You can see that the price informativeness have really only risen for the large growth firms. And investors have really chosen to acquire a lot of data, produce a lot of data about large growth firms. Everybody else is a loser. And finally, I want to talk about measuring the value of this data to investors, which is very heterogeneous because investor characteristics are different, stock characteristics are different, and importantly, market conditions are different. We use a statistical approach to measure the utility of investors from having some data. And this utility has a couple of components. The first component is a simple Sharpe ratio square, which everybody in finance would believe in. The second piece is basically the variance reduction in the returns, which is implied by the data that the investors have acquired. And the last piece has to do with the risk aversion of the investors. Now you can translate this utility to the dollar value of data by computing how much money an investor is willing to take instead of having this data. And so you can compute the value of data to investors of different sizes. A 500K investor is a small investor. A 250 million investor is a large investor. Investors who invest in different portfolios, in portfolios of small stock, large stocks, growth stocks, value of stocks, let's say S&P 500 index, or everything. And more importantly, about the price impact. The value of data in thousands of dollars is affected by investor wealth, surprise, surprise, by investment style, and most importantly, by market liquidity. So, of course, a larger investor values the data a lot more than a small investor. Investors who invest in large and growth stocks value the data the most, but more importantly, and this is very interesting, market illiquidity or price impact heavily reduces the value of data, especially for the large investors. So compare 566 with 23. A large investor who invests in a big investor, a wealthy investor who invests in a portfolio of large stocks, value data a lot more when there is no price impact. So price impact not only reduces the value of data across the world, but it really concentrates it. The value of data reduces a lot more for bigger investors because they have a larger price impact. They have to use data to invest a lot, to change their investment a lot, and that moves the price against them. So let me conclude by just saying that we need to think about data as a traded product, because data markets are on the rise and regulation is on the rise. And that has given rise to data intermediaries, and we need to understand them. Also, data processing technology is a product, and that has led to emergence of these digital intermediaries. Think about large tech firms like Amazon, Google, and Microsoft. They do large investments in digital infrastructure and then rent out these services like storage services and computational services, especially to new entrants and startups that reduces their barrier to entry. However, they can also have non-competitive behavior. So the technology is really transforming the market, and we need theory and measurement to make sense of this constantly evolving landscape. Sorry to go over time. I knew that.
So yes, thank you very much, Maryam, for a very interesting talk, and I think it's given us all lots of food for thought. So, you know, as investors, of course, it's always great to have more information about the companies you're investing in, but you really highlight this channel where that can have very heterogeneous effects on the economy. So I'll start with a few questions to you, and then we perhaps take some questions from the audience, and then also go on to the panel. So from your talk, it seems like we still have a lot to learn about this new economy that we're in. So as researchers and policymakers as well, I think we have a pretty good idea how to deal with sort of more traditional industries. But sort of what's your sense, like how far behind the curve are we when it comes to big data? I mean, both in research and also policy making. What do you think are sort of the most pressing issues to understand?
So of course,
you can stay a little bit closer to me if you want.
Exactly. Of course, this is my personal view, but I think research and policy making really is lagging behind because we need a lot of actual data to understand the role of this data, because it's really it's not that they're like new forces that we never knew about, okay? But these are forces that require measurement to understand whether they're relevant or not relevant, okay? And I'm really hoping that there's going to be a closer channel of interaction between industry and academics and policymakers that can help us understand these main trade-offs in data production, as well as data acquisition, and the data usage, and competition, importantly, and helps us understand this in research and design better policy. I
mean, I think conceptually it's sort of because when you look at sort of the graphs, it's just like, well, data is data and big data is just bigger data. But there's really something different about the fact that we have so much more data and we can process it so much more quickly, which sort of requires us to somehow rethink our models and how we deal with it, just because things are possible that weren't possible.
I think you raised an important question, an important point, that what data has been around in its predictive role forever. What has changed is the sheer amount of it and the technology that we can really make sense of this thing and use it. And there's a question of, okay, who wants to acquire this technology? And what does it mean for some people to have this technology and not some others? And it's really only with this abundance of data and improvement in the technology that these questions emerge. Before that, they were not important.
So what's the role of policymakers here? So in your talk, or in your research, you talk about this sort of small firms could be stuck in a poverty trap, but also we've seen this S shape here of growth. Whenever economists see an S shape anywhere, they think, okay, market failure, policy needs to step in and do something. So you have these companies that just by nature of their size won't produce sufficient information. And I was thinking through it as you talked. I mean, and the information that they're not producing is economic transactions. So really, it's very difficult. What would a policymaker do? What should they do? How, if anything? But let's say, you could sort of design the perfect policy. What would it be?
So again, I'm of course guided by my own research. So I think one important role that policymakers have is to do an efficient market design. Okay, market design has been a very important role of policymakers in a lot of things. Okay, in kidney exchange, in like matching doctors. And there's like so many important things in to think about market design, and there is no discussion of efficient market design in about big data. Moreover, what's important is that absent the research, my research at least says that absent frictions, the firms should be willing to share a lot of data in a way that improves efficiency, but they don't. So there is other barriers to that. There are frictions. It might be because banks are heavily regulated entities, and it might be many other things. It might be competition. And that is, I think, another important role of policy, to try to adjust existing policies which did not address this question of how to use data or how to efficiently share data, to adjust and allow for efficient data production and sharing.
Yeah, I mean, just to sort of add to that, I guess whenever there's something that is non-rivalrous, there are increasing returns to scale, it becomes, the market itself will not necessarily sort it out. So there's a lot of role for policy making here. So one final question from me. So in your research, I get the impression that on average, it's always better for a firm to produce more data. So firms should be willing to put data out there so that the investors can learn something, and that's beneficial for the firms as well, because it actually lowers their cost of capital. So that's kind of the model of firms versus investors. So when I think of the setting of companies versus their customers, then I'm wondering whether it's such a win-win situation, and how should we think about that? I mean, yes, if I have a model in which the only thing that I care about is that I have a lot of variety of nice trainers, then, which actually is the kind of models that economists write, then of course, yes, I should be willing to share all my data with Amazon and then Adidas and so on. But there might be other concerns in this sort of, I have a sense it's sort of a bit of a tug of war, and it's actually there where regulation is coming in. We have now a lot of new data protection laws. What do you think? How should, I know it's not what you've worked on, but how should researchers think about that?
It's a very interesting thing, and that's actually like my newest research is exactly thinking about that, that margin. And I mean, okay, so there are two margins. So one margin is the margin of privacy, which is very important, but that's kind of further away from what I do. But there's another margin, which is about competition. Firms can use the data of a customer to price discriminate against that customer or about the rest of the customers. Okay, so it is unclear if firms can use data as a non-competitive tool. Regulating data and data usage by the firms is very valid, has very valid arguments for it. It might be better off that it might be the case that firms have to pay customers to get their data to basically make them at least break even for sharing their data, because exposed are going to be price discriminated against. So I think this notion of competition and non-competitive behavior is really a critical thing, which has a lot, which entertains a lot of negative effects of used data.
Yep.
And exactly,
and that's before we've started thinking about privacy issues.
Exactly, and that's totally before that. And so far in my research, I have mostly focused on what are the gains of the big data and who benefits from it. And now I'm going more toward what are the costs of big data and who is losing to it.
So let me ask the audience, are there any questions for Maryam about her talk? If so, you can raise your hand. Yes, there. And please also say your name and what organization you're from.
Hi, my name is Simon and I'm from the Ministry of Finance. And my question is, how do we discern, how do we decide what data to incorporate in the model when you analyze any kind of market? Because I remember reading a headline a couple of months ago on Bloomberg where it said that what happened in Argentina, according to this value at risk model, had a 99.9% chance of not happening. And that was after the far left candidate won and the stock market crashed and the currency crashed. And the headline kind of was ironic, saying that maybe it was not the model that had the right prediction, but the model was faulty. And so that's my question.
So your question is very important, very difficult to answer. So let me try to think about it in two different dimensions. One is that even if you have perfect data, you cannot make the risk zero. Okay, so there is always the possibility that something very bad happens. The data decreases that possibility, but of course, like some rare events can always happen. However, there is still a point of what are really the meaningful data that can be used to predict a particular phenomena. It's not meaningful to throw anything that you can into a model and try to predict it. And beyond that, I think it's very important to understand the economic mechanism that is leading to a particular value of at risk. Okay, so and each economic mechanism requires a particular set of data. Okay, so if an economic mechanism is only guided by the available data, it has the problem that it might not be the relevant mechanism. It's just the mechanism that we have the data for. So maybe I haven't seen that, but maybe it's leading to that we use data that we had and we assume that they govern the model. But look, that is not the right model. So I don't think big data implies that we should ignore economics of the things.
Yes.
It's more of a conjunction.
And I think sort of how to understand then what we do with big data, our two panelists also have a lot to say about. So let me invite Sven and Anna. So thank you so much. Thank you so much for participating. So then actually now you're closest to me, so I will start with you, Anna. So let me just ask you kind of for your impressions on Maryam's presentation and sort of, how this connects to what you do in your day-to-day business.
Yeah. So very, very interesting. So in general, what we see and what I have seen the last years is that big data is kind of moving into some kind of smart data. Data is out there, everyone knows it, everyone has some kind of data angst. They know they should use the data, but they don't know really how to do it. So our business model at Whispr Group it's about having the technical capabilities and the best analysts to help companies to get the insights out of data in different ways. So that is delivering the insights to the companies that don't have the technical capabilities, the AI functions, the machine learning needed to handle the data. So that is a business on its own. So I really agree that big data is here and has been here for many years. The data is now turning into smart data that you can use it, but companies, they still have a long way to go, and they really need a lot of support in this field.
Mm-hmm. And so how would you say, I mean, your field is marketing, so how specifically has big data affected that field, you'd say?
Yeah, what happens is that we are a data and analytics companies for companies or people working within communications, marketing, or business development. So what we do is that we help them to get a wider view of their field. So for instance, I previously worked at an energy company. So what is insights that we can get out of data, for instance? You know, I can do screening of online screening, social media screening to get the view of customers, my competitors' customers, how they view my company from many different views, from sustainability, from a pricing perspective, or any perspective that I would like to know more about. I can use reviews. It's heavily amount of data. Not many companies can access those data amounts to get more insights about how customers view exactly my company. And then I could combine that with data that is also available in Sweden, for instance, parliament data. So I get to know all the political parties, their view in this specific field of energy, in sustainability, the different people in the parliament, their view, how active they are. And I can use all this kind of information for decision making. But I need to be able to process that data to get any value out of it. So sometimes I say that if you have access to the data and you don't use it, you have some kind of data waste. So you don't use it for growth or you don't use it for efficiency.
Mm-hmm. Okay, and so let me ask you, Sven, so for your impression, some comments on Maryam's work and how to connect what you do.
Yeah, very similar observations. I think the data is oil analogy is the right one, but I think we're at that point where it's not clear what should you use this sticky substance for. It's not. I mean, the engines are not yet invented, right? There are a lot of people out there. To your point, right? All we need is faster horses, right? So combustion engines is not yet well understood as a concept, right? So yes, we produce some oil, and some companies have really nailed it, right? So, but this has dragged on. I think it's not exactly the right analogy in the sense that. When the combustion engine was invented, I think it rolled out faster, right? But here we are, like 10 years probably after you and I saw that this is happening. A lot of firms are still struggling, and I think value from data comes from three components. It's number one, data, and volumes of data is better than big volumes of data is much better than small volumes. Number two, the capability, which is a function of technology and talent. And number three, applying it to relevant use cases. And tying this to regulation, I think we're shooting ourselves in the foot so many ways by safe harbor agreements, shooting it down, and sort of locking ourselves out of the full value. Privacy is this, no, we can't do it. It becomes binary. No, we can't do that because that's sensitive data and we can't do it. Whereas, thinking about, to me it's provocative that we don't have a big global database on cancer imagery available for all, open and available for all researchers everywhere to go in and do machine learning and AI and to sort of discover what causes cancer. Why are we not building not just imagery, by the way, but patient data and patient survivors? How do they fare, right? It's Sweden, Nordics, Europe. It's too small of a data set to actually be really valuable, but we could do so much good with data. Instead we say, no, that's very privacy, we can't, it's sensitive medical data, we can't use it. Anonymize the data, make it useful and store it in an open platform. That could solve. So now I'm drifting away from the commercial and very financial, but it's just, we're not there yet, that where the combustion engine is discovered and we're flying through space. It hasn't happened yet.
Mm. So the sense I get from both of you, and which sort of is perhaps, doesn't quite gel with what Maryam said. So in your talk, it's like there's so much data out there, and there's sort of no limit on that. Whereas what you're saying is actually, well, yes, there is so much data out there, but actually our capacity to to deal with it is still, which I know you also have in your model actually, but it's not exactly that that dimension that you explore. But our capacity to deal with it is still very poorly developed. Is that sort of a fair?
Yeah, I really
summary?
agree on that. So you really need, of course, it's mainly the technical capabilities to handle all the data. That is not normal within every company to have those kind of capabilities to really bring out the insights. And of course, you need the right processes around it to handle the data. That can also be poor. But I think that companies are on different levels. We have beginners and we have intermediate and we have advanced, how far they have come on their data-driven journey, so to say. And I would say that when you can handle the data and you have the technical capabilities, the next challenge is that when you get the insight, you need to implement that in your organization. And that could be, I would say that that's where the advanced companies mainly fail, because they can't handle the insight from an operational point of view when they're going to implement it in the organization. So first you have the data, then you need the technical capabilities, and then you need to be able to act on the insights. And then when machines and people should work together, machines are rational, people are not.
So I liked your point there. I was almost thinking sort of as an economist, well, you know, the world just did the wrong thing in Argentina. The model was clearly correct.
Exactly.
So why don't you behave as I thought? I wanted to pick up on two things. So one thing that you said, Anna, which sort of shines through there, is that actually a lot of the data analysis that you do, it sounds like it's actually text analysis. Is that correct?
Yeah, that's part of it.
Yeah, which is sort of a whole another kettle of fish. So on the one hand, we have these huge data sets, and you know they're very big, but perhaps we were still just calculating some averages or something. So in that sense, our methods of how to process the data are perhaps the same as they always were. It's just there's so much more of it. Whereas what you're alluding to is actually really a completely different type of data, where we're also still learning, you know, what are the algorithms, and then perhaps where we're coming into this limited capacity is a little bit like, I can sit there and I perhaps Google, okay, what's a good text learning algorithm, but I actually have to have some expertise in terms of evaluating, what is going to give me some kind of useful information here and what isn't. So do you want to elaborate on that a little bit?
It's like the data, I can just go back to that. Most of the data that we use at Whispr, that's open data. So that is actually accessible for everyone. It's the way we process it. It's the way we treat the data. It's the way we can use algorithms, AI, machine learning on the data to make the process efficient. So that is the key, the processing of the data. So it's not, data has a price, and it should have a price. Maybe we should have a market for it and things like that. But there is still a lot of open data, and that is for all companies to use. But that's where they don't have, in general, I would say, the capabilities to do so, because it's large amounts of data, and you need to be able to know how to process it in the right technology. So, yeah.
And I like this point that you made, Sven, about it's something we talked about also before we met, that especially in medical research, of course, having these big data sets available and this, being able to really make these very fine-tuned predictions of risk factors, etc., could be a real game changer. I mean, we don't know at this point, right? And so I think, you mentioned it, that so especially health data is really like people have very ingrained concerns, but actually could really be used for
it's
for
a little
good.
bit blocking, like the site, and we can't do that, and you turn away from it. But similar to we do, I mean, we use Whispr we deal in private markets, right? So we use typically. We only now a year ago shifted to actually producing data ourselves and making ourselves much smarter. But before that, we relied on for bigger buyout deals. We use you guys and sentiment analysis. Is this a good or bad asset? Is it trending in the right direction, or is its competitors doing better or worse? The use case that we have had runaway success with our Motherbrain team is in ventures and looking at publicly available data, we created an algorithm that when we applied it to historical data, we could actually see companies like Snapchat, Uber, Airbnb, and these guys runaway successes from an investor point of view in terms of returns. Very early. I mean, seed stage, A round. So coming in as an investor then would have been tremendous success, right? So when we apply that to real-time data using similar, looking at app downloads or social media mentions, web traffic, Google queries, etc., all these data, aggregating them and saying, okay, here's a linear curve that is starting to bend upwards, right? We have some form of exponential, that gives us a signal, right? And coming back to humans and computers, where computers, if there's 1 million startups born every year, there's no way, no team is big enough to monitor all of that. But the computer will tell us, here are a few, every day we get a few signals, here are some companies we think you should look at. And then the humans go to work and they say, this is interesting, this is not, for various reasons. So the computer just spews out suggestions for humans to look at. And the humans, they get that information far earlier than our competitors. So they get, here's something, right? And go look at this. But then, the human have to do, hello, dear founder, we think you have something really interesting. We'd love to be part of it. And that when we time that right, I think we've done 17 or close to 20 algorithmically sourced deals in our ventures team, and all of them are performing, very, very extremely well, I would say. I'm not going to go into details here. So for us, deal sourcing in ventures is one of many aspects we find are extremely. And here, coming back to my point about oil and data, there's another quote I like, which is, the future is already here, it's just unevenly distributed. And that's what you make money off of, and that's sort of what we try to play at as well. So as long as we have this big variation in capability, we like to explore this.
So thank you very much for a really interesting panel and really interesting presentation, and thanks to the audience.
Can I say something about the really amazing insights that I got from both of them? And I'm so happy that I put that one slide about digital intermediaries in, because those are really people who you both think they are the providers of data processing technology. The data is there. Now somebody needs to tell us or tell the firms how to process it. Then there is the second issue that you raised of, okay, you process it, how you implement the insight. But let's stay away from that. Just let's say, and so Whispr is someone who is exactly a digital intermediary. I've actually never talked about to somebody who is literally a digital intermediary. So great for me, but I'm so excited about that. At least my research is pointing out also to the direction that you guys think is the key to this big data revolution.
So I'm very happy SNS and IIES could broker that meeting then. Yes, so thank you very much, everyone. For those who are here in person, there's a mingle outside now after work. And, if you're lucky, maybe Sven can tell you how to pick the next TikTok. Thank you. And thanks for those who joined us online. Thank you very much.